Hello, everyone, and welcome to this podcast. What a fantastic opportunity to chat with the great Daniela Di Martino Booth. She is the CEO of Quill Intelligence and one of the people that obviously you must follow. If you don't follow her now, you will be severely punished. How are you, Daniela?
Severely punished. I'm doing,
Absolutely.
I'm doing great. How are you doing? It's good to be
I'm
back
doing
with you.
I'm doing great. Thank you so much for joining us again. We had a very, very interesting chat a few months ago.
We'll just have to move on to the weather because there's
Absolutely.
really nothing to talk about.
There's nothing else to talk about, no? Absolutely.
So I think that people are missing that there was a very valid reason in 2011 that Standard and Poor's downgraded the debt of the United States when the debt ceiling situation became similarly dramatic to where it is today. And that was because there was no discussion or any address of the long-term fiscal constraints that the United States faces because of its entitlement spending. Bear in mind, we're more than 10 years later, and that has still not been addressed. Fitch recently put the United States sovereign debt, this is before the debt ceiling drama began, that Fitch recently put the United States on an outlook for a potential downgrade simply because of the magnitude of the political dysfunction in Washington, D.C. That in and of itself, forget about paying the bills, but that in and of itself put the United States in a precarious position because they can't even they can't pass legislation in a bipartisan fashion and have not been able to for some time. So I do think that the Republicans are valid in saying there is a lot of kabuki theater going on. Treasury Secretary Yellen, in her testimony to Congress, is correct. Raising the debt ceiling is to pay for debts that have already been incurred. But what Republicans want to stop and talk about before they actually attach their names to any increase or suspension of the debt ceiling is, are we going to address our fiscal profligacy going forward? Are we going to address entitlement spending that's completely out of control, while at the same time all the Democrats want to accomplish right now is to actually increase that? So there's a valid debate going on right now.
Yeah.
So we're talking about structural spending here, and this, I think, is something that people need to better comprehend. Right now, the government is saying, well, we just need to hurry up and pass a continuing resolution so that we can keep the government operating. Just keeping the government operating, to your point, means constantly increasing the level of debt being incurred because we have these presuppositions that the level of spending that is normal, that is considered to be a normal course of business, is somehow correct. And that is a massive disconnect in logic, and one of the reasons that even prior to the pandemic, US debt was being run up at an untenably fast pace. And now what we're talking about is creating further social spending programs, and they never get canceled once they get started. We're dealing in the United States right now with a fiscal cliff and a slowdown in growth simply because there was too much money given to the people, and now some of that is being reversed. And what the Democrats want to accomplish is to make sure that some of these emergency programs that have been created are made permanent. And that is how you get into these deep structural impediments. That is what China likes to see the United States do, is to never have kind of a come to Jesus moment, if you will, when it comes to normal spending, which shouldn't be categorized as normal when it's excessive.
Uh, you just mentioned the likely downgrade of the US debt. And it seems like the mainstream message out there is that there is absolutely no risk the Federal Reserve is monetizing everything. Therefore, we don't have to worry about not just the rising level of debt, but the structural level of debt.
there are two different things going on here in the background. One is that there is concern, and I think it is feigned concern that the Federal Reserve is at risk of being politicized. If the Federal Reserve wasn't long since politicized, they wouldn't have facilitated debt service being as low as it is by artificially repressing interest rates and keeping them at the zero bound for as long as they have. That's one component of a discussion that, again, is very much disregarded. And in fact, one of the first comments Secretary Yellen made in her position at the Treasury Department was that she was no longer concerned about the run-up in debt because, contrary to what she'd said in 2017, because debt service was no longer really an issue. And again, that gets to the structural aspect of, as long as we can keep the debt service low and we can recruit the Fed to monetize every penny we spend, then there's really nothing to worry about as a country. And again, these types of scenarios do tend to go on for longer than logic would ever dictate. It's the same situation with stock market valuations and bubbles as they inflate and reserve currency status. But again, at some point, you will reach a level that something will break in the eyes of other countries. There is a euro bond out there. I'm not saying that the euro is going to rise up tomorrow and be a potential replacement for the dollar. But you've got China on the wires warning of the dangers of the profligacy that is enabled by quantitative easing. China, of all countries, is being critical and skeptical of what's happening at the U.S. Fed. So there are avenues that you can see in the future where at some point a lot of the world says basta, and we've had enough. And American politicians, again enabled by the Federal Reserve, can't see that as ever being a possibility, which is the height of hubris. These are very, very difficult discussions to have. Some of it comes down to work that Mike Green has done on passive investing. And that is that the more you pour into passive investing structures, the higher the valuations get, the higher the stock market tends to be. And part of the difficulty in convincing people that there are underlying problems with how people view economics and stimulus and the true reality of diminishing returns for every marginal of debt created, which we've just witnessed coming through fiscal and monetary spending combined, the likes of which we've never seen, and we're already talking about a slowdown. Some of this is covered up by, some of this is glossed over by the fact that the stock market acts as such a big offset. And when I say it acts as an offset, I'm not talking about the one percenters. I'm not talking about the wealthiest Americans or the wealthiest people in the world, for that matter, who control the majority of the stock. I'm more so speaking to the fact that it enables mergers and acquisitions, which covers up poor operating practices, and it makes sure that as long as the CEO and the CFO are wealthy and their stock price is held in check, then there's no danger that there's going to be massive layoffs. So there are very real ways that the stock market bleeds into the real economy that didn't exist prior to the structure of passive investing becoming as powerful as it is today. But again, we've just injected 43.2% of US GDP into an economy. I had somebody tell me yesterday that was just a pure offset to turning the economy off. And I said, no, because you don't have 43.2% of GDP created in what was technically a 2-month recession, according to the National Bureau of Economic Research. We put more in than what was needed, plus what the Federal Reserve has put in, and we're still already looking at what Cox Automotive has told us will be 5 consecutive months of falling car sales. Homes and cars lead. This is one thing Lacey Hunt taught me, and it's one of the most important lessons of my young macroeconomic days. Housing and autos lead economies into and out of recession, and we're seeing a slowdown of not small magnitude in both of these sectors.
No, that is one of the things that to me is more striking, is that with the magnitude of the fiscal stimulus and the monetary stimulus, the level of strength of the economy has shown to be so weak. The strength was so weak. The how quickly the slowdown has appeared, and how uh, abruptly in some cases. I think that one of the things that very few people expected was precisely what you've just mentioned, no? And again, it's the magnitude of the fiscal stimulus, the abruptness, and the speed of the slowdown. But there's a third element, which is that we are seeing margin erosion, real disposable income erosion through inflation. So what is your outlook in terms of?
I think that there is a vast underappreciation for how much companies are going to be guiding down their revenue and their earnings expectations. At Quill a few days ago, we ran an average of the United States, UK, Euro area, Japan, and Australia. We just looked at the pure average of their PMI's new orders, which says what is demand going to be in the future versus what their input costs are. There was a huge divide in between these two very basic metrics of, and this was the composite. This was the composite PMI that incorporated both services, both the services and the industrial economies of, again, these five major developed nations. I don't think investors are prepared for how much earnings expectations and revenue expectations are going to have to come down, again, because there is no stimulus check 4.0. So there should not be an expectation that U.S. households are prepared to continue spending as they did throughout 2020 and the beginning of 2021, where it looks like spending peaked in April of 2021, which happens to be the last the month that the third stimulus check was distributed. And again, these are simply things that are being ignored, but they're being ignored by an overwhelming majority of market watchers, which again I find to be striking and remarkable, especially because the refrain is the Fed's got my back. Well, guess what? That worked after the financial crisis. The Fed alone could act after the financial crisis, but the Fed cannot act alone now. Now we know that you have to have massive fiscal spending to accompany it. And on top of that, because the spending, which Richard Werner will teach you, when you have fiscal stimulus directly injected into people's checking accounts, when you give people money directly, it causes real inflation. The inflation may not be protracted in nature, but it has indeed caused real inflation. So regardless of what the Fed does next, it will be tantamount to a policy error, regardless of what they do. If they taper, it'll be a policy error. If they don't taper, they're behind the curve. They have boxed themselves into a tighter corner than they ever have, because in the history of the post-Volcker era, there has never been a leader or even a group of leaders at the Fed that has had to deal with the stagflation staring them down the barrel right now. But that is exactly where we are. But again, as I said to you, it's a global phenomenon. The stagflationary impulse is very much global because we're already seeing a slowdown in Europe, which came much quicker than I think most were expecting. But again, Europe didn't inject 43.2% directly into the veins of European consumers. So it does make sense that we would see a bit faster slowdown in Europe.
Absolutely, absolutely. And one of the things I think is important as well is it's been almost more than a year that since we've been talking. You have been talking. I have been talking as well about the risk of stagflation. And you've mentioned the eurozone. The eurozone peaked in terms of its recovery in June. No piece of data from the Eurozone has been incrementally positive since June. And on top of the problem that we have with growth, there is an underlying important problem as well. Is that the earnings boost that you get in the United States from the technology sector, you don't get it in the Eurozone because there's no technology sector to call for. So
Right.
That is another important problem.
It is, and I think that people right now are viewing commodities through a slightly warped prism because we have to bear in mind that the pig shortage, and this is a huge subject, the shortage of pork is no longer a real issue. On the other hand, as the rest of the world was shutting down forcibly in early 2020, China was already reopening. And while commodities effectively crashed, they were stockpiling everything from primary metals to soybeans. And what China is doing right now is releasing these reserves that they've had so that the pressure on their economy is not as severe as what is being felt around the rest of the world. And that is why right now China is being seen as this bastion of growth amidst a world that is slowing down. Part of it is because they're placating their populace. What China cannot defend, if you will, though, is energy.
Yeah.
And I think that increasingly we are going to see a divide, if you will. I'm fairly bearish on commodities going into 2022 as China tries to get its emissions down low enough for that February the 4th, first day of the 2022 Winter Olympics. So a lot of what we're seeing right now is being orchestrated, but I think that a lot of commodities will therefore come under pressure, with the exception of what China doesn't have, and that's energy.
Yeah.
So that will make it even more problematic as we head into the winter months, because natural gas stockpiles have not been replenished in Europe. Obviously, Russia's playing a hard game, and natural gas stockpiles have also not been replenished in the United States. So these are the things, these are the visible forms of inflation that are so difficult for households, even as the Fed's policies have made renting and buying a home, which is 33 to 40% of your average US household's budget, what they spend. So they're going to be spending more at the gas pump, they're going to be spending more to heat their homes, and they're going to be spending more to live in a home. And these are the kinds of non-transitory sticky inflation that are going to be very politically damning going into an election year 2022, and very difficult for the Fed because, again, they're going to appear to be behind the curve even as the economy is slowing. If they tighten into such a situation, they're just going to make the stag portion of the stagflation get worse.
Yeah. Central banks are in a damned if you do, damned if you don't situation. You mentioned China, and I think that the situation in China is hugely misread by the markets. I think that the situation in China, both at the level of crackdowns and the real estate sector, is being overlooked at too high a risk, I believe. And what is your take about what's going on over there?
So China's long-term goals have long been to create, to fabricate, to engineer a more balanced economy. And a few years ago, they realized that something that was impeding the pathway of getting to more domestic-led consumption was the fact that property prices had been really hit by speculation and too much liquidity being thrown at this one sector. So what we're seeing with Evergrande, as dramatic as it is, as much as the media loves to focus on it on a day-to-day basis, what we're seeing with Evergrande is it's not trivial in any way, shape, or form, but it is accepted. And the Chinese officials want for property prices to come down because your average Chinese household right now is dedicating too much of their budget to housing and not enough to other forms of consumption that will, again, open the pathway for a more balanced Chinese economy in the future, which is, again, a lot of what we're seeing is being orchestrated, again, as dramatic as, oh my gosh, the junk bond market. There's a good reason we haven't seen contagion into other bond markets around the world, and that is because Chinese officials are sending out a very determined and preordained message that they want Chinese households to have more income to dedicate to other areas of spending.
Which is very interesting because people are in some form ignoring the Evergrande problem, which is not even the biggest problem of the real estate sector in China. Evergrande is not the most leveraged company in the sector,
Right.
and the I actually made this calculation the other day. In order to get to the level of leverage that made some of the real estate giants collapse in the housing bubble of 2008 in countries like Spain or in Iceland, you would have to go to the top 15 of the most leveraged companies in China. So the level of gearing is so aggressive that the orchestration of the Chinese government might seem futile to me. I don't know how they can manage, on the one hand, the liquidity problem that is going to be generated. On the other hand, the problem that very few people talk about, which is that a lot of those real estate developers were issuing commercial paper that was being sold to citizens in their pension funds and little savers, etc. So that's going to create another problem as well.
It is, and I think I think if you want to come full circle with this discussion, what we forget is that in 2019, global trade itself contracted
Yeah,
around the world. China hit a 30-year low in its own growth rate in 2019. The world was headed into recession in 2019, and people want to say that the pandemic is what caused the underlying weakness, but that was not, it simply wasn't the case. So the baggage that we carried into 2020 is still with us in a very big way. The leverage that you cite is correctly very much with us in a big way. Corporate America, the corporate bond market, February of 2020, it crossed the $10 trillion line. It's $11.5 trillion today. Those balance sheets haven't been cleaned up. They're bigger. So I think that people have their memories are so short that they can't remember that prior to the pandemic, there were a lot of major challenges that were facing the global economy that have never been addressed.
completely. One of the things I had this discussion the other day with a German economist. They were saying, "No, the recovery of the eurozone," and I said, "Well, you must have to think at least of recovering back to where, because in the fourth quarter of 2019, the French economy growth was zero, the Italian economy growth was zero, Germany was in technical recession."
That's right.
Was also coming down aggressively from the levels of recovery that it was 2 years prior. So we tend to forget that we're recovering to stagnation. We're not recovering to a trend that was robust and of high productivity growth, but rather the opposite, no?
No, and it's not stagnation that we're recovering to, it's stagflation.
Yeah.
Because the monetary and the fiscal response to the pandemic actually made the situation worse than it was before. So again, huge challenges, many of which are being disregarded. And you overlay demographics on top of all of this. We've had too many retirees pull out of the workforce who were good, productive workers now. And now you're having to pay up too much in terms of wage inflation for not the same skill level that's retired. So there are some crazy, crazy disconnects and disruptions that have been caused by the magnitude of the response to the pandemic that sent net worth in the United States up to 632% of GDP, enabling a lot of older people to say, you know what, between my stock market portfolio and the value of my home, I'm out of here. And a lot of them are going to start collecting their Social Security payments early. And this could end up being the worst thing that you see for this cohort of 55 plus workers that said life is too short in a post-pandemic world. I'm leaving. Because now you've got wage inflation, they're living on fixed incomes, everything's more expensive. And again, the pandemic response actually made a situation that was very stagnant in 2019 that much worse, because now you add inflation onto it, on top of it.
And one of the reasons why it's so much worse and so quickly is precisely because you had this coordinated response from central banks and governments to do exactly the same aiming at a centralized planned outcome that would be equal and robust, and at the same time getting everyone in the same boat. And obviously, that's stupid. No? That is impossible. And what they have generated is a much larger imbalance and
Mhm.
a much more prolonged imbalance. And I come back to your point about the inflationary pressures and the transitory sort of argument from the Federal Reserve. I mean, at some point right now, Daniele, the central banks should at least start to say, well, you know, we were wrong, because the transitory element is way behind us. The base effect is way behind us. And we're seeing that China's having problems with the ability to purchase coal, which is a commodity in which there is ample capacity.
Mm-hmm. And again, these are some of the catch-22s because you can't even count them. And I think that the situation in the U.S. auto sector for itself, for example, I think that will end up being a very long transitory period, but that it's going to correct itself because car prices are too high and there's no money to buy cars anymore, and everybody's bought a car. So a lot of the situations that are going to work themselves out in terms of specific commodities, semiconductors, et cetera, that's not going to take care of what's happened with shrinking workforces and the spiking prices that we've seen in rental and housing inflation. So again, there will be persistent forms of inflation in the worst ways. And you're right that central banks need to own up to the role that they, along with fiscal authorities, have played in creating this really awful backdrop.
Yeah, completely. I'm going to give you an example of what's going on in the Eurozone with the automotive sector. I purchased a vehicle this summer. I purchased a vehicle, a high-end vehicle, rather expensive. Okay, when I purchased this, the owners of the company said, well, the waiting list for this vehicle is 3 months. It's high-end, fine. Well, it's 3 month waiting list. Okay, fair enough. I don't have a problem, so I'll reserve it. And 2 weeks later, I had the vehicle in my garage. 2 weeks later, and then you saw car registrations in the Eurozone collapse. I saw the figures and I said, "Oh, now I understand." Car registrations have gone down the drain in so little time after a very short and almost mirage-like recovery. So that's something to pay a lot of attention to, because we're going to this bullwhip effect in the economy.
It is. I ordered a door that I was warned because the door had glass in it as an element that it would take 9 to 10 weeks, and it's taken 2.
Yeah,
Now I'm like, what am I going to do with this door that's coming? Because I had a much longer pathway to get ready for this 250-pound delivery, and this thing that was going to take 9 to 12 weeks, whatever they were saying, such a backup in the glass and blah blah blah. Now it's all of a sudden on its way and here any day now. I'm like, well, how did that happen? But again, bullwhip is a really good analogy to use, and I think we're going to be seeing a lot of that again. And but there could also be, I think, a buying opportunity for commodities once the Olympics are over and China tries to destroy the environment all over again to get its industrial sector revved back up. But that's a different story for a different day.
Absolutely, it is. Absolutely, it is. We've had a great time as always. I think we've talked about a lot of great things, and it's always a pleasure to discuss with you. Thank you so much for your time, and we'll take the opportunity to catch up on the next big thing in a little bit longer. Thank you so much.
I'm, I'm looking forward to it.
It's been an absolute pleasure.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.